So please help welcome Superior Gold, a Canadian-based gold producer that owns 100% of the Plutonic gold operations located in Western Australia. Superior Gold is focused on expanding its production and building an intermediate gold producer with superior returns for shareholders. Here to tell you more is CEO Chris Jordaan.
Thank you. Good morning, everyone. And thank you very much for joining me today for a quick update on Superior Gold. Just as a reminder, please refer to slide 2 on our presentation, which is posted on our website, to view our cautionary language regarding forward-looking statements. Please also note that the numbers that we'll show you is in US dollars unless otherwise stated. Oh my word. There we go. Right, first question, where we're situated. The introduction said we're situated in WA. Well, it's literally right in the middle of Western Australia, about 1,000 k's by plane from Perth. It's a full FIFO site with full infrastructure there. We've got a camp, sporting facilities, pool, gym, etc. For the people coming in on FIFO. And then all the operations are situated in close proximity. However, we also own 100% of the Hermes project, which is towards the south over here, and then 80% in the Bry Basin JV with Alchemy with Hermes South. Now, that's very important from a strategic perspective because we just started this year with our program on surface drilling, and it's specifically focused towards the east of Hermes South, but a little bit more about that later. The first and foremost thing that I would like to share with you is just our strategy. It's a very simple, straightforward, solid strategy, and we've progressed quite far down the line in delivering that strategy. Just to give you a quick update what it's all about. Firstly, we had to stabilize the underground mine and get the business to positive cash flow, and we achieved that in 2021 after a very dismal 2020. We ended up the year with no debt and $23 million in the bank. The second part of our strategy is building a business of scale. Now, this business is ore short, and therefore, the more ore we can get, the more we can feed into our mills, and we have an installed capacity of 3 million tons per annum, currently operating the 1.8 million tons per annum mill. The 1.2 million tons per annum mill is currently in care and maintenance. Sorry, just want to get it back. The first part of building that business of scale is taking it up to 100,000 ounces per year. And if our plans work out, and we're heading towards achieving that annualized rate in the second half of this year. That's built on 3 pillars insofar as our strategy is concerned. The first thing is building capacity on our underground mine, taking it up from 835,000 tons in 2020 to 2021 to 900,000 tons this year, with an exit rate of 1 million tons per year towards the end of this year, specifically in Q4. In addition to that, we used the first quarter and the second quarter to do 2 shutdowns on the milling circuit. It's a piece of work. It should have been done typically every 7 to 10 years. It has not been done in the history of this mine, which is 30 years old. And it was very interesting, those bearings, our SGI bearings, the company, in fact, in Germany asked us to send those bearings back because they wanted to understand why they lasted so long. But in essence, we've been able to address all the vibration issues on the mill, and the mill is now running at full capacity. The next important step that we want to take is increasing our capacity to 150,000 ounces. The key element there is accessing additional ore of about 100,000 tons per month. We're looking at a number of options, both on our own property, but also looking across the fence. Given our geographic position, we're in the midst of many gold tenements that currently don't have milling capacity, will not be able to stand on its own feet insofar as developing a process plant and then trying to get it into a deal, whether it's a JV or through M&A activity, but then pulling those resources into our own business to be able to get that mill running. Of recent, after we've announced our resource and reserve statement, we in fact have a view that we might be able to get quite a significant portion of that ore from our own property, which will be first prize because it's so in such close proximity to the current mill. The last part, which is something that runs concurrently to the other key deliverables around our strategy, and that's about growing through the drill bit. If we look at our resource and reserves, when we acquired the asset in 2016, we had about 200,000 ounces in reserve. We currently have 630. We had about 1.5 million tons in resource. We now have almost 6 million ounces in resource. So a significant uptick insofar as inventory is concerned, and also the extent to which we can now access alternative options on our own property to enable us to unlock that full potential and get the mills to run at full tilt. So what's the story and how we've delivered across the quarters? Really the most challenging time was in 2020. You can see that we produced about 64,000 ounces that year. Extremely difficult operating circumstances. We then focused on the underground mine in the first quarter. In the second quarter of 21, we focused on moving away from legacy ore into fresh open pit ore, specifically at Plutonic East, Perch, and now recently Main Pit Deeps. That's enabled us to get higher grade, more consistent rock feed, and you can see immediately the benefit insofar as our production is concerned in the third quarter. In the second and the third quarter. In the fourth quarter, really pushed hard. We achieved 84,000 ounces annualized, delivering just short of 21,000 ounces in that quarter. Commensurately, our net cash position improved significantly. We don't have any debt, so the business and the balance sheet is really in good shape. The important thing here to note, and I spoke about it, in the first quarter of this year, we took the first shutdown on the SAG mill, which ultimately resulted in us now being able to run the mill at full tilt. So needless to say, we did take a hit on production and a bit on cash, but still delivered an excellent performance in that quarter. Just a little bit on the results that we've achieved. Just give me a second. If you look at our revenue in FY21, $137 million. In the first quarter, we did $30 million. You can see that changed because of the impact we had in the first quarter. I think another important thing is that you can see here our cost increase because of the lower production. However, our intent and the strategy that we've pulled together to go up to that 100,000 ounce annualized rate in the second half, we'll see the cost drop significantly lower than that number, and if we're going to push hard enough, probably lower than that number. Our guidance is $1,450 per ounce at the lower end. Apologies. And the main reason for that is, as you know, Western Australia was basically a bubble in a bubble in the COVID world. The borders opened in March. We saw a spike in COVID cases. When the mandate for masks were taken away, we saw another spike, to the extent about 12% of our people were impacted by COVID. We've been able, subsequently to that, to pull that back to about 3% of people being impacted. So the impact of COVID on the operations has certainly been controlled well. And what we're hoping is to ultimately now push hard to get that cost down to that level. In fact, if you look at the previous year, some of the months that we ran at 100,000 ounce annualized rate, the costs were, we could demonstrate the cost was significantly lower than that. And it's very important for us to drive that margin, but also to ensure that we have proper cash flow into the business. Then a piece of work that we started around about February last year was to re-evaluate the ore body that we had. Plutonic is an extremely convoluted and complex ore body and very difficult to describe spatially where the ore is in the underground. We then started a process and partnered with Leapfrog that provided the software, but we also then, together with them, designed and defined the whole process of taking into consideration thousands of data points, all from the Barrick days, Northern Star, and our latest drilling results, to be able to spatially predict exactly where the ore is. Now, the benefits have been quite significant. You can see here our mineral resource and reserve improved significantly over that time, and we now moved into an asset which has legs way beyond 7 years. Jumping forward on the work that we did specifically around the block model for the mine. The one thing that I'd like to call out, if you look at the process we followed initially, was firstly, it took a very long time to review the model. We used a lot of geos compared to what we're using today. It's moved from a manual process to an automatic process to a large extent. So as soon as we have data, we feed it into the system and it automatically updates it. One key measure of success that we identified was firstly, in the first 5 years of Superior Gold owning this asset, we only mined between 8 and 12% out of the reserve. Now you might think, well, that's really good, so the other 80 or 90 odd percent is still there. What it made it, in our view, quite difficult, firstly, to forecast exactly what we're going to mine, where we're going to mine, to set the stopes up properly, and ultimately that led into high costs. In the first 4 months of this year, in fact, we converted over to the new block model in January. In the first 4 months of the year, we moved from 8 to 12% mining in reserve to 55% mining out of reserve and 100% out of the resource. Now that's a significant step up. That will enable us to accelerate going into new areas and also to go forward with the development of the mine with much more confidence. Insofar as our guidance are concerned, we got in between 80 and 90,000 ounces this year with an exit rate of 100,000 ounces this year. Cash cost between 1,300 and 1,450. This is US dollars. If we look at the all-in sustaining cost, as I said, 1,450 to 1,600. But once again, just want to remind you, it's a conservative number, and we've taken into consideration a significantly bigger impact insofar as COVID is concerned on the operations. If we look at our exploration expenditure, this is really a part of our success story. In 2020, we basically spent nothing on exploration just purely because the business didn't have that money. In the next year, we spent $3.7 million, and in fact, only in one area, added 600,000 ounces to our mineral resource on the inferred category. Insofar as, by the way, and we're upping that to between $7 and $10 million. The main reason is we're progressing with the underground mineral exploration, but also now added surface exploration, specifically towards the south of our properties. Insofar as sustaining capital is concerned, between $6 and $8 million, and then $8 to $10 million in non-sustaining capital. The reason why non-sustaining is elevated from last year, we're building a new tailings dam, so that's a key important element of us setting the business up for long-term operation. A few highlights that I'd like to call out. Probably the first thing is really the development work now following on from the new block models that were designed. We've put a technical team together and in fact restructured the organization to be able to discern between long-term planning and short-term planning, as well as business development, because at the end of the day, we try to do everything out of the from the operations, and that just did not work. A key element there is taking the block model and now converting that into a proper life of mine. So at this stage, the jury is still out on where we're going to go with the underground mine. We can see line of sight and very confident to deliver 1 million tons per annum from the end of the year onwards. The intent here is to see whether we can get that even higher than the 1 million tons per annum. The ore is definitely there. It's a question of how can we cost effectively deliver that project. That all will be specifically focused on feeding into the current mill. Another thing I'd like to call out is that the business is now probably pivoted through a position where it's really well stabilized. Of course, we're going to increase production and reduce our costs, but we will now be in a position where we start looking at alternative options to de-risk the business, given the fact that it's a single asset business. Insofar as the capital structure is concerned, very tightly held, only 123 million shares outstanding. The net cash position at the end of Q1 was $20 million, and market capitalization currently about 102 million Canadian dollars. Very good coverage from our brokers. and all of them on a buy rating. In fact, our target price went up from, I think, $1.24 in the beginning of this year, and it's now heading towards $1.60 at $1.55, sorry. Insofar as our key shareholders are concerned, we've got a very strong membership insofar as our shareholders concerned, long-term shareholders supporting the business, given the fact that we have gone through a difficult time, but now looking forward to a better outcome. And we certainly demonstrated over the last few quarters that the business is heading towards much better times. Just coming back to the strategy, and I think the key thing that I'd like to call out is moving up to 150,000 ounces is probably the next big step that the business is going to take. The key element there, once again, is looking at ore on our own property, on our own property, as well as looking at other properties in the area. And we are in talks with a number of tenement holders. That process hasn't progressed far down the line yet. However, we're going forward unabated with our own options on our site. In fact, towards the east of the current operations called Plutonic East, it's a previously mined underground mine, Plutonic East open pit, and what we call Big Fish is currently on desktop phase to try and see whether there's potential opportunities. The reason why we felt confident to do that engineering work, to understand what's there, it's based on the work that we've done on the current underground mine and our ability now to better predict the spatial positioning of the ore on the underground. Insofar as the exploration is concerned, we believe that we're probably on point there insofar as expenditure is concerned. We have seen through our benchmarking that businesses of this size in that area typically spend between, on the lower end, $40 to $50 per ounce produced on exploration, moving up to about $90 to $100 per ounce produced. In our case, we're now about on the $90 to $100 case. All of these investments are fully financed internally through our own cash generation, and we're looking forward to the second half to pluck the fruits from the hard work that we put in Q1 and Q2 this year. I think that brings us to an end in the presentation. Any questions? Okay, thank you.